Our aim tonight is to try to help you understand what the tax cap is all about, try to dispel some myths, try to make sense as to how it is actually going to be implemented, because there's a lot of propaganda out there that this 2% tax cap is going to be the cure-all for society's ills, so to speak. So what I'm going to try to do is explain it. It is a little complicated, but I'll take any questions that you may have, and then actually show you what it means specifically for Lynbrook in dollars. The 2% tax cap legislation. The legislation, just so you understand, everybody's been saying 2% tax cap, 2% tax cap, right? It actually states 2% or less, 2% or the CPI, whichever is less. So, if there is a year that CPI happens to be 0, which a few years ago CPI was 0, that would mean that our tax levy would be able to increase by 0. Okay? For this year, it is 2%. CPI, does anybody know what CPI is? Consumer Price Index. Okay? It's really the rate of inflation, what we need to keep moving ahead in society. What money do you need to bring in order to pay for the things to keep you functioning in today's society? Okay, so now, knowing that it's really 2% or the rate of inflation, whichever is less, does that mean that your school taxes are going to increase by no more than 2%, or whichever is less? So that means our current levy of the $62,950,943, if you multiply that by 2%, we would have that $64 million figure. Is that what the 2% tax cap means? Absolutely not. Okay, this is the formula. So it's not taking a levy and multiplying by 2%. This is the formula. It is the prior year tax levy, which would mean the tax levy that we're living in right now, which is that $62,950,943 figure. And then what they say is we're going to take that figure and we're going to multiply it by the tax-based growth factor, if any. Tax-based growth factor actually should be given to us by November 1st by the Office of Real Property Services. We have not received it yet. But we know that that number cannot be less than 1. So for the purposes of this presentation, we're going to take our prior year tax levy and we're going to multiply it times 1. The growth-based factors is going to rely on if there's any growth within our school district boundaries, if there's new construction. It could also mean if someone is building a full dormer on their house. They take all of those things into consideration, and the Office of Real Property Services will say, do you have any growth in your school district? If it's enough, if it shows, then our growth factor may be 1.03 or 1.04. Anyway, anything more than 1 is actually going to help us move the district forward. But it cannot be less than 1. Then what we do is we take that figure and we're going to add pilot receivables. Now pilot stands for, follow the acronym, Payment in Lieu of Taxes. This would be any property that is yet to be on the tax rolls, so they pay something called a pilot. They pay this instead of actually paying taxes, like when all of us receive our tax bills in our home. We happen to have one property in our school district boundaries that is considered a pilot payment. Okay, and I'll show you what that figure is later. So for us it's 1. I'm going to add the pilot money we would receive. Then I must now subtract a few exemptions. And in the parentheses you see these are the various exemptions that the state has offered us. One is capital. Okay, capital refers to any brick and mortar project. So they're telling us it right now. So if we do any particular small construction project, and I'll show you a figure in the next slide of any capital improvement type of thing, but I will tell you, even when Dr. Barbarino and I attended a superintendent's meeting regarding this, there's information out there that it could also include any capital equipment. State hasn't made a decision yet if they're going to include capital equipment. However, our strict interpretation of it is brick and mortar, so that would mean any construction. So for the purposes of this presentation and for where we are right now, that's what I'm going to refer to when I talk about capital. Debt service. That would be, and you've heard me if you follow along with the budget work sessions, our bond principal payments, our bond interest payments, that is our debt. So we're allowed to exclude that. We subtract that. However, it's not the full payment, it's net after building aid. So when we have done construction projects and we've bonded and we have borrowed money against construction projects, we receive some building aid on that. We happen for this year are receiving $606,000 in building aid. So I have to take our bond interest and principal, subtract out our building aid, and then that figure is the exemption. Any leases could be exempted if we happen to lease a building, which we don't have. Any court orders, but court orders don't refer to the tax certiorari's. And if anyone's following along with last year when we had all of the discussions about the tax certiorari and the county eliminating the county guarantee, that means that if you're not happy with your taxes and you challenge your taxes because the county assessed your home improperly, so you challenged your taxes, the county up until last year was going to make you whole. They were going to reimburse you. They eliminated that. They've now put the onus on school districts. Guess what? That's not included. So no matter what, I have to include that always in my 2%. That's not considered a court order, even though it is a rule, a judgment ruled by a court. Okay, you do that formula, and then you get what they call an adjusted prior year tax levy. Then I get to multiply it by that 2% or the CPI, whichever is less. Then I'm going to subtract the pilot, I explained to you before, and then I get to add any carryover. That means, for example, the 2%, say we were able to put together a budget that was only 1.5%. That extra 0.5%, I could actually include that as carryover for the following year, if any. Thank you. All right. Yeah. Okay, so now this is what it means in numbers for us. There was that tax levy, the prior year tax levy, multiplied by that 1. Add in the pilot, the $198,000. That's the pilot money we anticipate receiving this year. Minus the exemptions. That was the debt. Minus the building aid, putting it in there. So we get an adjusted prior year levy of $62,453,235. Then I get to multiply that by the 2%. I'm subtracting, though, the pilot, the new pilot that I anticipate receiving in the 2012-13 year, add any carryover, which we don't have any. That is our tax levy limit. You see, it's only an increase of $529,343, or a 0.84%. Don't worry, it's not over yet. Okay? That's the first half of the formula. Alrighty, so that though is a key figure. We take that figure. Now, can you please just move on to the next thing? That's the tax levy limit. But the key number is what they're calling the maximum allowable levy. Okay, this is the maximum now. The maximum means you're going to take that tax levy limit, but now you get to add back all those exemptions. You know how I had to subtract all the exemptions from the prior year? Now I get to add all of the upcoming exemptions. So the debt service, so the new debt service minus the building aid, I get to put back in. Any court orders, I get to put back in. Capital projects, put back in. And then, folks, this is the mandated relief we got. If the employer contribution rate for pension increased by more than 2%, we get to exclude that increase. I'm going to illustrate, there's a slide I'll illustrate what that meant for us. But I want you to keep in mind, a 2% increase in employer contribution rate does not equate 2% increase in dollars. You'll see in a minute. Okay, go ahead. So here we go. So the tax levy limit was the $63 million. The upcoming exemptions, $568. The capital, that's going to refer to that $140,000. Those are two projects that during the budget work sessions we will be proposing to get accomplished in what we call the interfunded capital codes. Okay, see that $33,000? That's what I'm allowed to exclude for the ERS, for the civil service pension this year. TRS, look at that. I get to exclude nothing because they happen to not increase the employer contribution rate by more than 2%. So I don't get to exclude any of that. I will tell you that in putting the budget together so far, that in dollars has increased by more than 10%. In dollars. Okay? That gives us the maximum allowable tax levy. So the $64,223,088, that is the key figure for Lynbrook, where we stand right now, assuming they don't change any of those definitions on us. Okay? So that's an increase of $1,272,145. So that 2% tax levy actually for Lynbrook means 2.02. We're allowed to increase our levy 2.02%. But Notice on the bottom there, it says it must be submitted by SED, to SED by March 1st. That's a new requirement now. So by March 1st of every single year, school boards must report this to the state, what that maximum allowable tax levy is. Okay, they're just going to follow us on that. If we stay at that percent increase or below that percent increase, we do what we've always normally done. If the budget passes by a simple majority vote, we're golden. Okay, the budget has passed and we move on. The key is if we exceed that 2.02%, that's where we have to go to what they call a supermajority. And I'll explain that in another slide. Here's the pension exemption illustration. For that ERS, that $33,000 in the prior slide that I showed you, that's what we're able to exempt. The contribution rate for this year was 16.3. So for next year, it went up to 18.9. So the total increase was the 2.6. 0.6% is what I was allowed to exclude, okay? Because they did allow us the 2%, but the 0.6 is above and beyond that. And in dollars, that 0.6 translated to that $33,000 and change. Okay. Dispelling the myth. Although it's a 2% tax cap, is the tax rate going to increase by no more than 2%? No, it's not. And I just put these simple numbers on here just to explain. The tax rate formula, in case you didn't know, is the tax levy. Now, we all know that's what we're talking about right now. That is the one figure the school district is responsible for, the tax levy. What money do we need to raise to keep the district going? You take that tax levy, though, and you multiply it by what they call an adjusted base proportion. Nassau County gives us that number. They say, okay, Nassau County has 4 classes of taxes: the homeowner, condo owner, utilities, and commercial properties. And they say, okay, of that total tax levy, homeowners, you're going to be responsible for 63% of it. Commercial, 10%, whatever it adds up to 100. Okay, they break it down. And then you take that and you divide it by the overall assessment. Okay. Year 1, let's just say that the tax rate is $630. That's because the tax levy was $1 million. 63% was the adjusted base proportion, and the assessment was $1,000. Okay? Now, year 2. Guess what? I'm not even going to go up to 2%. I won't even confuse you. I'm keeping the levy the same. The levy is still $1 million. But Nassau County decided to give the homeowners more of a share of it. So they're up to 64%. But your assessment didn't change. Notice I kept the assessment the same too, just for illustration purposes. But what happened to your tax rate? Went up. Did the school have anything to do with it? Did I change anything? Didn't change the tax levy, right? But Nassau County changed the adjusted base proportion, and even the assessment didn't change. So if your home was assessed at a certain amount, you take that same assessment and you're multiplying it by a higher tax rate. The tax is going to go up, even though we didn't raise it a dime. Okay, so that when people say, and when people call the county complaining about your taxes, and they automatically say, it's the school's fault, it's the school's fault, this is here to show you, it is not always the school's fault. Next slide, thank you. And on top of trying to fit this all in together under a 2% tax cap, we have some unfunded mandates. One local mandate, Nassau County, we're forced to next year go to the computerized voting booths. Okay, you're going to see an increase in the budget of $13,000 just for voting booths. Does that have anything to do with education? Common Core curriculum, another state mandate that's coming down. Between the curriculum writing, textbooks, software, and everything that's related to it, look at that price tag. What it's going to cost to implement that state mandate. RTI, another state mandate. APPR, local assessments. This is the new evaluation for our professional staff. They're forcing us to go out and purchase assessments in order to implement this APPR. Look at the price tag. And then all of the trainings, because obviously everyone has to be retrained in how to do this. All state mandates. So, we have to keep our budget and our tax levy low, but they're putting all of this on us. Thank you. Okay, so now, what happens? If we go above the 2.02%, okay, we're going to be forced with making some difficult decisions. If we have to reduce the budget to get to that 2.02%, these are just some items. Well, I'm not saying that we are even entertaining these right now. These are just up there because these are non-mandated programs. We don't have to have 7th and 8th grade athletic teams. We don't have to have any middle school summer programs or high school summer programs. We don't even have to have full-day K. Kindergarten. These are just possibilities of what districts are going to be faced with now. What are we going to cut? Because we know we're forced to do the mandated things. What are we going to cut in order to keep this tax levy down? Thank you. Okay, so what are our options? Okay, option 1 is for us to put forth a budget that is at that tax cap or below. That will require just a regular simple majority, is what I mentioned before. So regular, we just need 1 plus 50% of the population to vote who votes to pass that budget. Option 2, if we need to exceed the tax cap, it will require a supermajority. Supermajority means 60% of all the voters who come out, they have to vote yes. Okay, it also, a new mandate is we have to put a statement on the ballot indicating that it does exceed the tax levy. So we just don't put the proposition out there as in the past and then let people decide. We actually have to bring light to the fact that we are exceeding the tax cap. Now, what happens if it doesn't pass? Okay, it may, if it's above the tax cap and it passes, but it doesn't pass by the supermajority, it's as if it failed. It may pass by the regular majority, but it's as if it failed. Okay, so we would be allowed to, once again, go back to the voters on the 3rd Tuesday in June, put forth another budget, and see what happens. However, what's different this time around is if it fails a second time, we don't go to that contingency budget that I've spoken about before, because a contingency budget kind of gave you some leeway. It allowed you to go up by CPI. It was actually, the formula for that was 120% of CPI. So that at least kept in with the times. If you needed to move forward for expenditures, you were able to do that. If your budget fails a second time, 0%. No ifs, ands, or buts. You don't even get a chance. 0%. And the scary part of this is no exemptions. All of those exemptions, like the debt service that people had approved back in the late 90s that we have to pay, not allowed to exempt that. It's just a straight dollar amount, 0% increase. So in conclusion, we hope that this presentation has been able to clarify and explain some of the particulars that are associated with the tax cap legislation. While there are still some unknowns, at this point in December of 2011, this is the formula and these are the numbers to illustrate to you how the tax cap legislation would actually affect the Lynbrook Union Free School District. As more information becomes available to the school district, of course we will in turn share this information with you at public board meetings, via our website, and any form that we possibly can to make sure that the community has all the information it needs to make an informed decision. Thank you very much for your time this evening.